One of the biggest misconceptions about creating wealth is that you have to be an ultra high earner in order to become a millionaire. And oftentimes that's not true. I'm Brittany Anderson, president and partner at Sweet Financial Partners out of Fairmont and Jackson, Minnesota. We've had the great pleasure and are so fortunate to have worked with a lot of high net worth individuals, people that have been diligent about saving and have been diligent about accumulating money. And there's some common themes that happen with them. So today I'm going to walk you through 7 steps that you can take on your path to becoming a millionaire. It may not be easy, but the formula itself is incredibly simple. If you don't tune into this, so if you decide to shut this out, you don't go any further, you could risk the opportunity to hit some of your most important goals, most important objectives that you have for yourself. And you could essentially risk not creating the life that you can't wait to wake up to, the life that you know you are capable of creating, and the wealth that you want for yourself, for your family, and for your future. Now, if you're tuning into this and you're somebody who has already accumulated, these are things that you can put into practice still today to create even greater possibility for yourself, again, for your loved ones and for your future. So to give a little context to this, growing up, I grew up in a single parent household, and my mom worked a heck of a lot to support our family, to support my brother and I. One day, I remember I was around, I think, 8 or 9 years old, and I saw my mom sitting in her room, and she was sitting on her bed, and she had all of her bills laid out and had checkbook in hand, and she was crying. And she was crying because she wasn't sure if she was going to be able to put both a roof over our head and food on the table at the same time. So it was in that moment, even at such a young age, that I decided that I wanted to create a life that was in control by me, that I could actually have some control over the outcome and not put myself in a situation or not have to be in a situation where somebody else's choices or some life event or whatever negatively influenced me, my path, and my future. And then as I got a little bit older and wasn't that 8 or 9-year-old kid anymore, I realized quickly that I wanted to be able to help others and, be part of an organization and a team that helped other people to be able to create that possibility for their future and understand that it doesn't matter where you came from. It doesn't matter what circumstances are behind you. What matters is the steps that you take going forward. So that's why we're diving into these 7 steps to becoming a millionaire today, is so that you too can realize that it's possible. It takes work, it takes effort, but it's possible. So, first step when you're looking at your own path to becoming a millionaire is realizing that mindset is everything. And this isn't just the woo-woo, far-fetched, way out there stuff. There are there's true science to back this. So we all have within our brains the reticular activating system. You can Google this, you can look it up yourself if you want to. But we have this reticular activating system that essentially is built to allow you to focus on the things that you value, to perceive certain threats, and to support the goals that you've set for your future. So let's take, for example, let's say that you decide to get this very specific black SUV. You've done your research, you know which make and model and all that good stuff that you want to be yours. So all of a sudden, you start seeing that exact black SUV everywhere that you go. Now, it could be that you just have great taste and you're up with the times, but the reality is that RAS, that our reticular activating system, has now tuned in to what you've deemed to be important. It's now tuned in to what you've said is something that you want. It's a goal you want to achieve. It's something that you want to bring into your life. So your brain has literally decided that it's tuned in to see evidence of that. So the point here being is that if you're telling yourself that either you came from a life or a background that didn't have wealth, so you're not capable of having that, your brain is going to start to find evidence of that being true. If, on the other hand, you decide that you are worthy of the wealth that you desire and that you are capable of creating that seven-figure future, then your brain is going to tune in and look for evidence of that as well. So when you think about your mindset, it's not just the fluff. It's not just the hoping and wishing and that good, warm, fuzzy feeling. There's actual science behind it to show that where you put your attention, what you believe, your brain is going to start to look for. So when you think about becoming and putting yourself into that millionaire mindset, those people are not any more special than you. They are simply focused. They know what they want, and they're taking action to move forward and get there. Same thing rings true for people that have accumulated. If you're in a scarcity mindset and you're afraid of loss, you're afraid of not holding that wealth that you've accumulated, then that can present a problem as well. Because what happens then is you end up essentially underspending versus overspending, which is another common misconception that we see a lot. So we'll talk more on that here in a minute. So again, you want to tell yourself that, paint the picture of what your ideal future looks like, and then take action towards that. Help your brain focus on the right thing versus the things that can set you back. So step 2 on your path to becoming a millionaire is simplification. Now, this is one that maybe isn't as sexy or fun as the mindset component, but it is equally important. So one thing that we hear a lot when we're talking to high net worth individuals is that they want to create ease for their heirs. They don't want their heirs to be left with a mess or having to pull a whole bunch of things together and be stressed during a time of essentially mourning. So something that you can do, and something that we see oftentimes with the people who have accumulated high levels of wealth, is that they're simplifying their assets. And what we mean by that is that instead of, let's say that you have an IRA that you contribute to every year. Plus, you have a few different times that you've changed careers, changed paths. So you have 401ks out there. So let's just say you have one IRA and you have 4 401ks, and you're at that point in your life where you're ready to retire and you're looking at the purpose behind consolidation. Now, some may think, oh, it's a pain. I'm just going to leave them sit where they are. I don't want to deal with it. Well, here's the problem. If you are, again, embracing the mindset of a millionaire, of the people who have built and accumulated that high net worth, then they're often looking at simplification for their heirs. Now, if you pass away or when that day comes, if you don't have things consolidated, all of a sudden your heirs have to make, in this particular scenario, 5 different phone calls to 5 different companies, provide 5 different copies of death certificates. They have to open 5 new accounts, and now they have to maintain at 5 separate places these accounts that you've left. Now, let's compare that now to you actually simplifying and consolidating. So you move all of those 401ks, that accumulated assets, move them into one IRA. Now, all of a sudden, what happens? Now, your heirs have to make 1 phone call, provide 1 copy of a death certificate. They have to manage 1 account going forward and deal with meeting with 1 advisor. You see the difference here. So again, if you're looking at when you've built that high levels of wealth, when you have created that millionaire, lifestyle for yourself, this is something that you can do for the next generation and beyond, and quite frankly, for yourself as well. Because again, if your heirs are having to deal with upon passing that type of situation, you're having to deal with that in the current moment, the current situation. So bringing it all together under 1 particular account can be helpful when it comes to simplifying your assets and simplifying your future. Point number 3, we're going to talk about the value of saving young. All right. So again, if you're listening to this, you're already at that accumulation phase, because oftentimes that's who we end up working with, is people who have been diligent accumulators. There's one thing that keeps coming up though, and they continue to ask, what can you provide for our children, for our grandchildren, something that can help them create the life that we've created, something that could help them to also become diligent savers and accumulators of wealth. So that's who this is for. So when you think about this, we're going to talk about just the idea of compound interest made really, really simple. All right. So we're not going to go highly technical here. Just give you a little tactical piece of advice. So let's just say that, every day you get up, you get ready for work, and you go to the gas station and you spend, let's say, $3.50 on a bottle of water and a Snickers bar, or maybe just in today's world, it's just a bottle of water. I don't know, but let's just take a $3.50. So per month, if you times that out, it turns out to be about $105 a month. Annually, times that by 12, it's about $1,260. Now, let's just say that you had taken that $1,260 that you're spending on water, literally water every single year, take that for 30 years at an average of, say, a 6% annual return, just taking this as a hypothetical, that could be $106,000 saved. So again, this doesn't have to be complicated. This doesn't have to be rocket science per se. It's maybe changing a couple small daily habits that can in turn add up to a really big cumulative effect when you look at the potential return on savings. So again, nothing is guaranteed here, but this gives you a framework or a thought process to think through when you're looking at what it means to save. Oftentimes we'll hear people, well, what if I don't have a bunch of extra income? What if I don't have, right now things are strapped, or maybe I just started a new business and I don't have a lot to put away, or, whatever situation you may be in, maybe you'd shifted careers, whatever that looks like for you. The point here is that the value of saving young and starting at that earlier stage, you can see the benefit of those small little behavioral changes over the long run. So that is point number 3. You're starting early. You can never start too young. So if you're, again, listening to this as somebody who has already hit that maybe distribution phase or retirement phase, which we'll also talk about in a minute, you can pass this on to your younger family members, your kids, your grandkids, people who can take action at a younger age to see the value that can happen, or that can happen over time. Point number 4, we're looking at the path to becoming a millionaire. Create your saving strategy. All right. So here's the thing. You have to find something that works for you. There are many different resources and tools out there that can give you a ballpark of, percentage allocation. So this much of your income should be allocated for housing, for extras, for food, for, your daycare, your whatever. So again, if you're at that stage of life where you're looking at this kind of accumulation phase, you're still saving towards your future, there is a really simple strategy that we often recommend for those early savers. And this is great too if you're somebody who, you're a high earner and that this is something that's in your future. You have certain targets. Even if you're listening to this and you are not in that high earner category, this is something that you can absolutely put in place that could be helpful to you when you look at trying to tuck something away for your future. So it's the 50-15-5 rule of thumb. So basically what you're looking at is you should not spend more than 50% of your income on essential expenses. So you're looking at your house, your utilities, your, food, those kind of things, the things you need to survive. Then your 15%, so we've already talked about the 50, moving on to the 15 is your long-term savings. So that might be if you have work for a company that has a 401k, if you're looking at maybe putting some into an IRA or a Roth IRA, or even just your regular traditional savings or individual type account, that's something to consider. So 15% if you're in a position where you don't have a 401k with a company match, that's absolutely a great place to start. But there are other avenues you can do to get to that 15%. And then you want 5% for more of the short-term expenses and your emergency funds. So, that would be something like your car breaks down and you need to repair it, or your furnace decides to die in the middle of winter, or whatever that looks like. You want to have something there so that you don't have to put yourself in a really strenuous, tight spot. So that is point number 4 when we look at the 7 tips to becoming a millionaire. Moving right along to point number 5. This is a big topic, and it's diversification of your savings. So, when I think about our advisors at Sweet Financial Partners, one of the things that they hear time and time again when they are face to face, when they're meeting with clients, is that, people, they don't ever regret saving. You don't ever get to a point in your life and you're like, gosh, I have just way too much money. It just doesn't come up. But what does come up, however, is the topic of saving too much in a pre-tax form. So what that might mean is that people have been really diligent about saving. They've put into their 401k, they've maybe put into their IRA, but they haven't saved anything where taxes have already been paid. So in an IRA or a 401k, all of that money is taxable upon distribution or withdrawal. So if you don't create some diversification, that could present challenges for what you're trying to accomplish. And I'm not going to go down the technical path. That's what our wonderful, trusted, brilliant advisors are for. They're professionals in their trade, and they're people that can walk you through your specific scenario. But the point here is that when you're thinking about diversification, you want to think about the later stages in life too, and what that might look like for you. Does it make sense based on your tax bracket to potentially, have something that you do pay tax on now versus later, and vice versa? So, not a tax professional, you definitely want to lean on your CPA for true guidance, but this is just some things that can get you thinking. So you might want to look at kind of from the bottom up, think about this as a build. So you want to make sure that you fund that emergency savings that we talked about, right? You want to have that cash on hand for the quick fix kind of things. Then you might look at a health savings account. So a health savings account, it can be a great vehicle. So if you have like the high deductible health plan, these health savings account can be great. They have tax deductible contributions, tax deferred earnings, and then tax-free distributions. So that can be a great vehicle for you to look at putting into if your current situation allows. And again, if you're already in this distribution phase of life, this isn't something that maybe you're doing now, but this is something that you can pass to your heirs, have conversations with your advisor to make sure that your heirs understand and know, and that multi-generational kind of effect comes into play. Also, you would then look at the build on this, right? Because we're kind of building from the ground up when looking at diversification. So you might then look at a defined contribution plan. So your company 401k, putting money into that, hopefully getting to some sort of a max or higher end contribution. You can look at your, having your own individual account or saving, something that isn't necessarily, put away pre-tax, but that is taxable or already taxed, so that it creates some flexibility for your future. You have your IRAs, you have Roth IRAs, you have different scenarios that you can look at. Again, there's certain times where you may or may not qualify for that type of account. You really need to consult with your advisor, consult with your CPA to make sure that you're making the right decision for your particular financial scenario. But there's different vehicles, different savings mechanisms that you can use that can be beneficial to you and looking further into the future versus just looking at the right now. So those are really important things that you'll want to pay attention to when you think about planning for your future. And when you think about what it means to, build towards that millionaire status, you want to be sure that you're being smart and you're making the best decisions that are for your particular future. There's nothing worse than, somebody coming in and sitting down with one of our advisors and, they want to use a strategy that their neighbor or their best friend or their family member, whoever is using, and they're taking it as gold, when in reality, that may not be best for their particular scenario. So that's why there's so much value in meeting with a financial advisor, a wealth advisor, to really help you make informed decisions for your future, especially when it comes to diversifying your savings. And then in turn, that's also diversifying your distributions when you get to that phase of life as well. So those are just a few things that you really want to think about. Point number 6, again, we're on the path to becoming a millionaire. You want to make sure you stay in control of your debt. Now, debt is a hot topic. You have kind of opinions all over the place on this, but the point is that there's both good debt and there's bad debt, right? Good debt tends to be more in the form of, that long-term vision, things that could potentially increase your income and increase your net worth. So that might be something like a home, having a mortgage, especially if you're able to get a lower interest rate there, student loans in some capacities. That can be something that it helps you towards a bigger goal for your future, creating possibility for yourself. So those debts can be good debts. Bad debts, on the other hand, tend to be something around like depreciating assets. So you might get something where a vehicle, vehicles, you've probably heard the adage, you've heard your parent, grandparent, you may have thought this yourself, as you drive it off the lot and it immediately goes down in value. So that's not always a good debt. Also consumer credit cards. So any major credit cards, store credit cards, those types of things, anything that has really, really high interest. Now, there are scenarios where we've seen people, especially, you get the wealthier individuals, the people who have hit that 7-figure savings, they may use credit cards to their advantage where, you use it to make your purchases, but it's being paid off every month. So there's no interest hit. So then you're taking advantage of some of the perks that some of those cards can offer, be it, cash back, be it travel points, especially for business owners, we see that taking advantage of some of the cards that have those travel kind of bonuses per se. So there's ways to make those things work for you, but the vast majority, you'll see it where, you get dinged with that interest, and that interest over time can be really harmful to your future plan. So again, you're looking at building that 7-figure savings, that 7-figure wealth. Well, you want to make sure that you keep these things under control and learn from some of the people who have done this well. So that's a big one. It goes back to is if you're looking at, making a decision where you might carry some debt, you look at this scenario. If I came to you and I said, all right, I need you to give me $2, but I'm going to give you $6 in return. Would you take that? Well, probably every day of the week, right? I think I would. So again, that's just like a hypothetical example, but that's something that you can look at if you're making a decision around, some longer term debt, like a mortgage, having that lower interest rate, and then being able to still save and put money into some sort of an investment vehicle where you may be able to earn interest that's even higher than what you're paying. So you have that differential where you're deciding, okay, I can get my head around potentially putting money into savings while carrying that debt because it makes sense for my scenario. So again, those are things that you want to weigh out. You absolutely want to make sure you're talking to a professional, that you are, getting good advice, that you have somebody to lean on who's actually done this every day and not your neighbor Joe or your best friend or whoever that is. You want to have people that do this on the daily, like our advisors at Sweet Financial Partners do. So point number 7, path to becoming a millionaire, is writing down your goals. This is something that I cannot stress enough, and something that we have seen play out for people's benefit time and time again. So if you have a big target savings goal for your future, for your retirement, you want to make sure that you're putting that out there and that you are taking tangible action towards that, not just having it be something that you're wishing for your future. Okay. So you want to make sure that, if you are in the accumulation phase at this point in your life and you are looking at saving for your future and creating possibility for your future, then you want to make sure that you have a specific target number that you are working towards. Now, this is another one that can be applied to if you're listening to this and you're already at that 7-figure stage, or you've already become a millionaire, or you are, at this transition and period in life where you're going to look at what retirement means to you. For us, it doesn't mean, by book definition, being put out to pasture. That sounds terrible. Nobody wants that for their future. I should say, I hope nobody wants that for their future. So when you think about setting goals, that can be something regardless of what period of life you're in. Our hope for you is that you're able to create the future of your dreams. Like, you're able to set goals that are meaningful to you. So you might say, all right, so I've done a good job at, building my wealth and creating that kind of cushion for myself and my future and my family. But here's the things that I want to do that are going to leave me feeling fulfilled. So it could be some extravagant trip that you've always wanted to take. Maybe you want to go see the pyramids of Egypt, or, you want to take your family on some wonderful vacation, to the Bahamas, or whatever that looks like. this is the time to start looking at how does that impact your plan and where does that fit in and when, and getting it booked, right? Taking advantage of that. For others who are like, you know what, travel's not my thing, but family time and legacy and that kind of thing is. So maybe it's creating a foundation in honor of something meaningful to you or someone meaningful to you. Maybe it's, putting time on the calendar with your grandkids or, your children, and taking advantage of that quality time while they're still young and around, in the area, and they haven't taken their lives on their own. So those are all things that you can think about when you look at setting goals and setting intentions for your future. Kind of looping this back to the first point we went over, it's mindset. It's deciding that this is what you want for your life, knowing that you don't have to justify it to anybody, knowing that this is what you're after, and then going after it with every bit of gumption being that you have. So setting something that gets you excited, setting something that makes you want to get out of bed in the morning. If you want some tangible tools, like resources that you can physically sit down, you can fill out, help you kind of think through all the things that we talked about today, you can go visit mysweetfinancial.com. Really simple, completely free. You can download the tools. It's called the Retirement Readiness Toolbox. It doesn't mean that you have to, again, embrace that retirement word, because we don't love it either. But that's a free resource, something that you can use to kind of map out. There's some videos to talk about how you use the tools. It's really simplified, but these tools can be monumental as you look at building your future and you look at creating possibility for yourself and what that means to you. So go ahead, visit mysweetfinancial.com. You also want to understand that, this whole journey, this path, when you're looking at, the whole point of this topic, becoming a millionaire and building that 7-figure accumulated wealth, there's going to be bumps in the roads. There's going to be uncertainties. There's going to be certain setbacks. And you want to make sure that you are embracing the mindset that does not allow you to stop, that doesn't make you feel like you have to just, completely get off the wagon because one thing threw you off course. You want to be able to stay tried and true, steadfast towards that bigger picture and that bigger goal you have for yourself. So highly encourage you on the Sweet Financial Partners YouTube channel. It's actually episode 5 of our Dream Architect podcast. So the current title on it, it talks about uncertainty in financial decisions and how you can tackle those, how you can definitely create that steadfast approach for your future so that you are not thrown off course and you stay true to what's meaningful to you. Your path's going to have bump in the roads. What matters is that you are able to put those uncertainties and curveballs on the table now in hopes of continuing to create the life that you can't wait to wake up to.